In an era defined by war, trade wars, and volatile currencies, investor confidence is rattled. From the weakening US dollar and sharp swings in FX markets to military conflicts and debt crises, traditional strategies are under pressure. Yet history shows markets often rebound, even amid global turmoil. Today, successful investors double down on broad diversification, tactical hedging, and quality assets like gold, defensive sectors, and resilient businesses. Today we will talk about investing during global uncertainty, from war to currency crisis. So before we start, make sure to hit the like button and subscribe to my channel. 1. Understanding global uncertainty. Global uncertainty encompasses a wide range of disruptive events, including wars, political instability, trade tensions, pandemics, and currency crises. These events create unpredictable financial environments that can severely impact markets, investor sentiment, and asset valuations. Geopolitical shocks such as armed conflicts or the collapse of governments can rapidly shift supply chains, impact commodity prices, and destabilize entire regions. Investors must recognize that uncertainty is not just a temporary phase, it is an integral part of modern financial systems. While some risks are cyclical, like recessions, others such as currency wars or sanctions can produce lasting structural changes. The unpredictability forces investors to think beyond traditional models and embrace both defensive strategies and diversification. Understanding the layers of global uncertainty, whether economic, political, or environmental, is critical to making rational investment decisions. 2. Geopolitical risks and market reactions. Wars, political revolutions, and territorial conflicts create immediate ripples in the global markets, often triggering sharp sell-offs, heightened volatility, and investor panic. Geopolitical risks impact oil prices, defense stocks, safe haven assets like gold, and government bond yields, often in rapid succession. When Russia invaded Ukraine, for example, global energy markets were disrupted overnight, spiking oil and gas prices while European equities plummeted. Wars involving major economies can fracture trade alliances, provoke sanctions, and realign global supply chains. Investors must also consider indirect effects. Even localized conflicts can have global ramifications, particularly if they involve resource-rich regions or critical shipping routes. Currency markets respond immediately to these shocks, often driving investors toward perceived safe currencies like the US dollar or Swiss franc. Anticipating market sentiment is as crucial as assessing the factual outcomes of conflicts. 3. Inflation, interest rates, and currency volatility. Global uncertainty often leads to inflation spikes and interest rate instability, especially when supply chains are disrupted or energy prices soar. Wars, sanctions, and trade barriers can cause scarcity of critical goods, pushing up prices worldwide. Central banks typically respond to inflation with rate hikes, but in uncertain environments, their decisions can become harder to predict. Currency crises often emerge from this backdrop when countries with high debt burdens, current account deficits, or weak political structures face capital flight and currency devaluation. For example, the Turkish lira's collapse and Argentina's repeated defaults showcase how fragile currencies can spiral during uncertainty. Investors must pay close attention to the dynamics between inflation, interest rates, and foreign exchange markets to identify both threats and opportunities. 4. Safe haven assets and defensive strategies. During global crises, investors typically rush towards safe haven assets to preserve capital. Gold, U.S. Treasuries, the Swiss franc, and the Japanese yen often experience inflows when fear grips the markets. Gold has historically served as a reliable store of value in times of geopolitical and economic turbulence. U.S. Treasuries, considered virtually risk-free, attract investors seeking security amidst volatility. Defensive equity sectors like consumer staples, healthcare, and utilities generally outperform during uncertain times due to their stable cash flows and inelastic demand. Investors should not merely reactively chase these assets, but proactively build exposure to them as part of a balanced risk strategy. Allocating to safe havens can dampen portfolio drawdowns when risk assets suffer sharp corrections. Beyond asset selection, using stop losses, options hedging, and adjusting position sizing can offer additional protection. 5. Emerging markets, high risk, high reward. Emerging markets can be both vulnerable and opportunistic during global uncertainty. On one hand, they often suffer disproportionately from capital flight. weakening currencies, inflationary pressures, and tighter financial conditions. On the other hand, their long-term growth potential, demographic advantages, and resource wealth can offer attractive entry points when priced at a discount during crises. Investors need to differentiate between fragile and fundamentally strong emerging economies. Countries with low external debt, substantial foreign reserves, political stability, and diversified economies can better weather global storms. For example, countries like India and Indonesia have often demonstrated resilience compared to more fragile peers like Argentina or Turkey. 6. Sectoral shifts and thematic opportunities. Periods of global uncertainty can accelerate sector rotations and bring certain investment themes into focus. For example, energy crises can propel oil, gas, and renewable energy stocks to outperform. Defense spending often spikes during periods of geopolitical tension, boosting companies in the defense and cybersecurity industries. Currency crises may favor exporters whose products become more competitive due to weaker domestic currencies. Meanwhile, inflationary pressures tend to benefit commodity producers, infrastructure, and companies with strong pricing power. Investors should identify sectors that align with the prevailing global disruption. Whether it's a supply chain shock, a deglobalization trend, or a military escalation. Thematic ETFs can offer targeted exposure to such trends. For instance, cybersecurity ETFs, global defense funds, and energy infrastructure plays can serve as tactical bets during uncertain times. 7. Portfolio diversification and global allocation. Diversification becomes even more critical when investing under global uncertainty. Spreading investments across asset classes, geographies, currencies, and sectors helps mitigate unsystematic risks. A well-diversified portfolio can absorb shocks from individual markets, currencies, or sectors that may be disproportionately affected by wars or financial crises. Geographical diversification reduces reliance on the performance of a single country or region. Exposure to developed markets, emerging markets, commodities, and alternative assets, like real estate and infrastructure, can provide stability. Currency diversification is particularly important during periods of de-dollarization trends or competitive currency devaluations. Utilizing global ETFs, multi-asset funds, and international bond portfolios can achieve efficient diversification. 8. Long-term mindset and strategic patience. While global uncertainty can trigger short-term market chaos, investors who maintain a long-term perspective often come out ahead. Historical data shows that markets tend to recover from wars, recessions, and currency crises, often reaching new highs in the subsequent years. Knee-jerk reactions, panic selling, or overly defensive postures can lead to missed opportunities during recoveries. Building a long-term investment thesis, centered on demographic trends, technological innovation, and structural economic shifts, provides a steady compass during turbulent periods. Investors should avoid overtrading in response to daily headlines, and instead focus on strategic asset allocation, disciplined rebalancing, and dollar-cost averaging. If you like this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.